Hello, students. Today we're going to talk about um, angel investors overview and insight. I'm Professor Bonaparte, Director for Masters in FinTech and Director for External Affairs. My job is to meet the business community, and I love to do that. What are angel investors? These are individuals who invest in their own capital in early stage startups, usually the size of investment between $25 to $500,000. They focus on high potential startups with scalable business models, and we're going to have examples later on. Who are angel investors? Accredited individual, executive, or ex-founders, investors, solo, or groups. Sometimes people retire from banks like JP Morgan, Morgan Stanley, and they want to run a business. So these are the type of angel investors. Key characteristic of this business: high risk, high reward, equity-based, hands-on mentorship, and exit-oriented. At some point, you will sell it and done with this business. Why angel investors matter? Because it's bridge the funding gap between friends, family, and venture capital. And if you have a business, probably you lean on your friends and family in the beginning, but you cannot go to the venture capital or banks also. So the angel investors in between, we need more than family, but less than venture capital. Drive innovation and job creation, and increase diversity in investing. What angels look for, what angels look for: strong funding teams, a large market opportunity, unique value proposition, exit potential, alignment of the vision. The key is the trust. You trust the people who make their presentation, and we're going to talk about how it works in this slide. How angel investment works: it starts with the pitch. Like, for example, if you watch Shark Tank, so somebody come and pitch, and then screening, diligence, term sheet, legal review, funding, support, mentoring, and then exit toward the end. You put $1 million, you sell it for 200 million, and then you're making some good money. The investment process steps start with sourcing deal, screening, due diligence, negotiation, post-investment involvement, which is a reflection on those. I just grouped them in a few steps. How angel structure deal: equity, like here's money and give me 10% if you're equity, or 50%, 25. Convertible notes, like a debt, and then convert it to be equity. SAFE, which is simple agreement for future equity. Preferred share. Risk and reward: risk is a startup failure, liquidity, dilution. Reward: high return and successful exit. And then we can have examples later on, like Amazon and Google. I'll talk about it. The angel ecosystem: it's an angel group, online platform, university and regional network, usually. Angel group like Denver Angels in Colorado and Rocky Mountain Venture Capital. And then you have a syndicate. I met a lot of them. So when the pitch is done, the person who make the pitch, and then the syndicate come and talk about the financial paperwork of this financial outlook. I want to compare here angel investors versus venture capital. Angel investors versus venture capitalist. Well, the feature. So the feature funding source is personal fund for angel investor. Venture capital is institutional fund. Investment stage, seed early. Here, Series A and B, and maybe IPO, toward IPO. Involvement, hands-on mentorship. You start like like you own the company. Here, strategic oversight. Check size, and this is critical. We're talking about 25 to 500 grand. More than that, 1 million will be a venture capitalist. Decision speed, fast, intuitive. Here, structured by and based committees. Trend and future outlook: rise of micro angels, increasing diversity, growing in FinTech, AI, ClimateTech. So what we see that the FinTech world increase the ClimateTech, cross-border investing because the FinTech is available at integration with the university hubs. A lot of venture capital or angel investors invest in students through a competition or this. They come and they do a lot of, like MIT has a lot of 7%, uh, maybe less, but if their students end up to be a unicorn. And I was a lecture about unicorn. Our real world examples, Google. I mentioned I'm going to have example. Google, you remember the 100,000 check from Andy Bechetom's Amazon, 1995, 1 million from early angels, friends and families. And lesson here is early conviction vindicates startup and annual. So let me go to you, Google. Google started by two PhD students right at Google. And then Andy came and liked the idea. He put $100,000 check and got equity. Now Google is a $1 trillion company, trillion with the T. Amazon the same. It was a 50,000, I think, a piece. So probably 20 people, 50,000 each, and they created Amazon, and Amazon is a $1 trillion company now. Summary and takeaway: angel investors are critical in a startup ecosystem. They offer both capital and mentorship. Success requires diligence and patience, and they shape the innovation and entrepreneurship. Your homework is this question: why invest despite risk? These venture capital angel investors. How do angels differ from venture capital? Which deal structure is best? Lesson from Google and Amazon. What sector would you invest in? So it's a more discussion question. Thank you so much, and I hope you enjoy, you learn, and that how it works, the angel investors, and you enjoy it. Thank you.